Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about silver, precious metals, economics and politics. Today is Thursday the 2nd of May 2019, and we're broadcasting part 3 of our interview with hedge fund manager and owner broadcaster of Macro Voices, Mr. Erik Townsend. In part 1, we discussed Erik's views on the precious metals markets, currency markets, and how long he believes the US dollar will remain the world reserve currency and what it may be replaced with. In part 2, we discussed precious metal pumpers, the eventual demise of the dollar, and the digital currency alternative that Erik believes it will be replaced with, though being very careful to point out that it's unlikely to be a cryptocurrency. Links to both of these podcasts are shown in the description section below this one. In part 3, we look into a little more depth about gold and silver prices and Erik's position on platinum and palladium. We also look at lack of regulation in the precious metal space and the reasons for it, and why Erik believes that the dollar has much higher values ahead. And finally, we cover balanced portfolio investments. So let's get into it. Erik, thank you so much for conducting the interview, which we've released to all of our subscribers. We're now within our inner sanctum where only paying members can view the continuation of our interview. In the general interview, we mentioned that you expected, potentially at least, gold and silver prices to fall. And yet, many pundits out there are advocating higher prices this year. This includes the World Gold Council, the Silver Institute, which, to be fair, are not always the hyper-bullish organizations that some paint them out to be. How confident, in perhaps percentage terms, are you that gold prices will fall and will reach, let's say, $1,200, $1,000, or, as you mentioned during the early part of the interview, $900 to $950? And then what about silver, although you did intimate that perhaps you weren't so confident in predicting sort of potential silver prices, but is $13 realistic, 11, 9? Where would you fit
Well,
into?
you ask precisely the right question, and it demands a kind of involved answer. So I'm going to break your question in half. How confident am I in my bullish view on the U.S. dollar? Pretty darn confident. Of course, nobody's right 100% of the time. There could be a change in geopolitical factors any minute that could change everything. But based on the way I see the world right now, I think the dollar is beginning a significant move higher against other currencies. And in the old normal, if you will, the way things usually work, that should mean that it presents a serious headwind for gold and silver, and that gold and silver prices move down. Now, hold on. One of the things that could drive the U.S. dollar higher is its value as a safety asset, because as we discussed in the earlier interview, there's a lot of things going kind of haywire right now in the global geopolitical scene, not the least of which there in Europe. You have the Yellow Vest movement, you've got Brexit, you've got the Italian referendum, you've got the divisiveness in the United States. The scenario where I end up being proven wrong completely, i.e., dollar crashes and gold goes up, I don't think there's much chance of that at all. But I think there's a very significant chance that I'm only halfway wrong, in the sense that the dollar does perform very well as I expect it to, but gold breaks down in the sense of its usual inverse correlation to the dollar becomes positive, and gold and the dollar are moving up together at the same time, because people are valuing gold as a risk hedge against geopolitical tension, not just as an inverse trade to the US dollar. So that would be the scenario in which I could get proven wrong about the dollar. What I look at is there's a major technical resistance level at 1350. So if we get, let's say, at least a daily close, but preferably if we stay above 1350 for a solid week or two, that tells me, okay, look, the jig is up for some reason. The market is really valuing gold, irrespective of what the US dollar is doing, as a risk hedge. I'm late to the trade. It's time to jump on here and just accept that I was late and I maybe missed my opportunity to get in at $1,200. But hey, you win some and you lose some. Barring the move above 1350, which is sustained, I think we're still in a regime here where there's plenty of room for gold and silver to move lower as a reaction to the US dollar moving higher. What's the number? I don't know, because I think that the dollar moving higher is likely to happen in earnest. Does gold move lower in earnest, or does at least some of that geopolitical risk hedge factor come into gold and maybe arrest the weakness that would otherwise exist in the face of that much dollar strength? I'm not sure. So we're going to have to wait and see. I think you watch those geopolitical factors that I talked about. If we get above sustained 1350 gold prices, I know it's time to throw in the towel and just say, okay, I was late to the trade, but let's not miss it. Time to jump on board here. The other thing that would wait, let's say we're hovering around 1200 and maybe looking like we're going to break below 1200, but I'm not sure if it's really going to break or not. If I start seeing the yellow vest movement go across Europe, so where all the cities in Europe are burning the way Paris has been for the last couple of weeks, it's probably time to buy gold and stop trying to time the bottom. On the other hand, if some of those geopolitical factors start to calm down a little bit, we get a little bit of reprieve, then maybe it's time to press on and wait for lower prices in gold. So I think that the bottom in prices is likely to come in the next couple of years, if not sooner. It's entirely possible that the bottom is already in, but the way that that would happen would be a geopolitical escalation. I think that if economic factors are allowed to play out and follow their natural course, we're going to get a better buying opportunity before this is over. Geopolitics always have the potential to change everything.
Quite a few of our subscribers come from countries such as the United Kingdom, Australia, Canada, obviously Europe, the majority being the United States. So if we have a rising dollar, de facto, their currencies are in proportion to the dollar are falling. Therefore, as a result of that, should they not be getting into gold now? Because bearing in mind, even though gold may fall in dollar terms, as far as their currencies are concerned, compared to the dollar, they're actually going to be paying more for it as well. And God forbid, if gold actually goes up at the same time as the dollar, then people in Australia, United Kingdom, Europe are going to find prices just becoming too expensive.
Yes, absolutely. I have to qualify my response by saying I'm a U.S. dollar investor. It's my base currency. It's the way that I think. And therefore, I haven't done my homework to really figure out the extent to which what you're saying is correct. I can tell you it's absolutely correct. Does that mean it's time, if you're a UK investor, you should be rushing in, but if you're a Euro investor, you should be scaling in but not rushing, and if you're a whatever investor, I haven't done that homework. I don't know the answers. But in general, the reason that I see a risk of there being a soft patch here where gold moves down in price is all about the dollar outperforming other currencies. And if you're in euros, particularly as your base currency, I think it's the euro that is going to be weakest against the dollar, and that's where there's going to be the most reason to think about, it's already time or perhaps past time to be investing in gold. If you're a dollar-centric investor, as I am, I think maybe there's a lower low still coming.
We mentioned earlier in the interview precious metal pumpers. We joke about them, but our underlying philosophy is that they have actually caused some significant damage to people's wealth, and that a lack of financial regulation allows them to get away with it. Why has no major government seriously tackled this issue and regulated this area
Oh, it's
more
exactly
closely.
the same reason that, look at everything that goes on the internet with various commerce laws being broken left and right by the spammers that are sending all kinds of illegal solicitations. There's no way for governments to get their head around and manage these things. What regulators are really good at is using the licensing mechanism as a tool to basically hold a string over the heads of everyone in the finance industry and say, look, you are not allowed to do business without your license, which, depending on what it is that you're doing, it's a different license. If you're selling stocks in the United States, it's a Series 7. In the UK, you have a completely different set of licenses, but you still have to be licensed. If you're trading commodities, you need a Series 3. If you're representing what Series 3 traders do to investors, you need a Series 65. And you're at risk of losing these licenses and potentially being barred for life from the industry if you screw up and don't follow the rules. And furthermore, you have obligatory reporting where you have to fill out all kinds of reports. And yes, they do get scrutinized, and you will hear from regulators if you screw up. That's their mechanism. What gold and silver, and this is a really important point taught to me, curiously, by a guy who's a veteran of many decades in the gold industry and one of the good guys, he said, look, Erik, the way this works is the people who get barred for life from the securities industry because they got caught insider trading or running an illegal commodity pool or doing whatever they were doing, they wind up in the physical gold pumping space because that's one of the few things you can do in finance that doesn't require any license. Because there's no license to take away. Regulators, in order to do anything about it, would have to go after you for criminal law violations, things like fraud and what's the larceny by making of false pretenses and so forth. That's a much higher of burden. They'd have to much higher burden of proof. They would have to hire all kinds of criminal prosecution attorneys and serve people with with legal process and so forth. The regulators of licensed finance professionals don't have any of those burdens of proof. All they do is they take your license away and they say, if you want to get it back, you have to prove to us that you didn't actually violate this rule in the way that it appears to us that you seem to have done. What happens to all the guys that get kicked out of the finance industry is two things. They write newsletters and they go into the gold and silver business because gold and silver, and particularly the worst of the worst, get into rare coins where they start with a bullion story and then the bait and switch goes to numismatic coins, and this is where your real opportunity is, blah, blah, blah. It's usually a bunch of baloney. Of course, there is some value in real coins, and people who are expert in that know that value. Most of the guys pushing numismatic coins are guys that got kicked out of the finance industry. They lost their license, and they're doing the one thing that's still available to them that they can do even after they've been barred for life from the licensed community. That's the way it works. So the newsletter writers and the purveyors of physical gold and silver coins are the guys that are not selling securities and are not regulated by securities regulators. They are breaking the law, but the people who have jurisdiction over that kind of law, where it's not regulated by any financial regulator, and they're guilty of fraud and so forth over the internet, long distance, the police are busy with murderers and rapists and violent criminals. They don't have time for this, and the SEC and others really only have time to regulate their licensed professionals that they have the most leverage over. It's way too expensive to go after somebody for fraud if there's no license to take away from them. And these guys don't have licenses. That's the reason they're in this business in the first place, is because they got kicked out of the licensed region of the finance industry, and they have to do the one thing that's left to them that doesn't take a license. That's writing newsletters and selling gold and silver coins, or if you're really trying to double dip, you write newsletters about why you should buy gold and silver coins from the authors of the newsletter. And there's plenty of people doing that.
That's fascinating. And obviously, things are not really going to change, certainly not in the short term. So perhaps one of the best safeguards someone can adopt is to educate oneself, first of all, to identify these sorts of people, but then to perhaps they themselves to look at the metrics that are publicly available, not necessarily at cost. Sometimes there are various subscriptions one has to make, but there are enough free metrics out there and data banks for people to identify for themselves whether this is an area they should actually start to look at. Because certainly I can speak on behalf of the United Kingdom, and I would guess it's very similar in the United States. Financial advisors are not paid, unless they charge a fee, they're not remunerated by recommending people take up gold and silver investments. And they get remunerated very heavily if they recommend equity, stocks, shares, funds, and so on and so forth. So what sort of areas should an individual who says, look, I'm interested in this, I appreciate my currency is devaluing year on year, and as we mentioned earlier, over 15 years will did we say halve in value, or whatever the case may be. So what should they be looking for? How can they educate themselves? What
I
are
think
your
the
recommendations?
one takeaway, the one rule that I recommend above everything else is to learn to spot the deductive leap, which is invalid, because all of these stories start from a valid, legitimate place, which has lots and lots of credible weight behind it. It really is true that governments have been reckless and irresponsible in borrowing and spending beyond their means. It is true that the entitlement systems of most of the developed governments of the world are unsustainable, and that some kind of financial crisis or collapse is inevitable. Okay, that's legit. It's all real. And they get you, just like a con man starts out by earning your confidence and trust, they start out with a bunch of credible stories. And then somehow they get from this inevitable financial crisis is imminent and it's going to start tomorrow. And if you don't buy gold and silver coins from me today, you're going to get left behind. They've been pushing these same stories for decades. And what you've got to do is learn to go through each of these deductive steps in the sales pitch and realize, okay, these are the ones that are real. This is that false deductive leap. We somehow got from it's inevitable that these unsustainable public pension and entitlement systems are going to eventually collapse in some way. The inevitability of that, wait a minute, how do we get to imminent? In order to get to imminent, you'd have to do an analysis of capital flows and say the demographic shift, and by the way, this is happening to some extent right now, the demographic shift is occurring to the point where we have so many more people that are claiming these benefits than are paying into the system, that the specific reserves that those systems have accumulated over the years gets used up on this date, and that's the point where those systems go bankrupt and have to be bailed out, and they will be bailed out because there's so much. You can't just stop having Social Security in the United States. The people have become so conditioned to the idea that that is a right that they're entitled to. They've paid into the system. They deserve to get their benefits. There's no way politically to turn it off, yet at some point we'll get to the point where it's impossible to service it without printing up a whole bunch of more money in order to do it, because there just isn't enough tax receipts in order to fund these unsustainable systems. Well, the way you get to that is you actually do all of the hard homework and you figure out when we get to that crisis point. And it's very complicated. A lot of people have tried to do it. It's a moving target. It's hard to get it exactly right because it does depend on public policy and so forth. But there's no reason to think that we're there right now. If anything, what the last 10 years have taught us is that if central bankers want to expand their balance sheets in order to support financial markets and keep things propped up. So far, to the astonishment of a lot of us, it's working, at least for now. Now, I think it's certain to lead to much worse problems down the road, but at the moment, it's working, and there's no signs of it failing imminently. So you got to look for where the imminent catalysts are that are going to change inevitable to imminent. How do I think that's most likely to happen? It's when the Fed is ready to rescue financial markets and the people say, no, we will not allow this to happen. We are going to insist that whatever the Fed does next is for Main Street, not for Wall Street. I think that could be a game changer. But until you get some catalyst that changes the game, they really can continue to be reckless and irresponsible and continue to spend beyond their means. And there is right now a dollar liquidity squeeze. It's not like everybody is dumping their U.S. treasuries, and that means the U.S. government is imminently in trouble right now. If anything, the opposite is true. There is a squeeze on U.S. dollar liquidity, which means there's demand for more U.S. Treasury paper. If the U.S. government needs to borrow and spend more money and has to issue more U.S. government bonds, there are plenty of people that want to scoop them up, even at ridiculously high prices and low yields. They can't get enough of them. So there's no reason to think that this is about to blow up tomorrow. It's coming someday, and what you've got to do is learn to look for the signs of it actually becoming imminent. The pumpers have been saying it's imminent for 50 or 60 years. They've been full of baloney, and most of them know it. They got kicked out of the securities industry and lost their licenses because they're full of baloney. And they've found a new home in the precious metals market because there's no licensing involved in many aspects of precious metals, and they can get away with it. So don't believe what they say. Do your own homework and figure out when inevitable, which it's been true for 60 years, actually turns to imminent. And it's coming, I think, in the next 10 years, but I don't know when, and frankly, neither does anybody else.
That's great advice, Erik. We've tended to focus on gold and silver, but of course there are other precious metals out there. Now, many of our subscribers have asked us to produce podcasts on platinum and palladium and to give an indication of where we believe their prices are likely to move and the reasons for that move. What's your, without going into too much detail, but what's your sort of general view of the other inverted commas?
Well, I think the most important investing lesson I know comes to mind here, which is never speculate in things that you don't understand well enough to have an edge over other traders. And in the case of palladium particularly, it's all about a very complex fundamental story having to do with palladium having very extensive use in catalytic converters. I don't claim to be an expert on this, but if we see the electric vehicle revolution truly succeed in the proportion that some people predict, then the demand for palladium goes down dramatically because they don't need it for catalytic converters anymore. You've got a counter argument, which is that the value of palladium has already been artificially discounted by an unrealistic expectation of electric vehicles taking over, which, frankly, a lot of people that are making that bet are being unrealistic about how long it would take for the electrical distribution grid to be upgraded to support that many electric vehicles. You got to understand these things really, really, really well before it makes sense to be a speculator in palladium prices. I'm not that guy, so I would never consider touching it. That's all I can say on that one. As far as platinum is concerned, it's a slightly different equation. Platinum does have some industrial uses. It also has jewelry uses. Once again, you don't want to speculate on something you don't understand. I don't understand enough about platinum or palladium to want to take a position in them.
That's great. Now, whilst we cannot give investment advice and will not even attempt to do so, we believe, as you do, read the future, that one should have an overall investment portfolio. Now, I come from an advisory background, both within the United Kingdom and overseas. And of course, my training has always been based on having a relatively balanced portfolio. It will never give you the greatest returns, but to some degree, it protects you against major falls as well. Well, taking into account the uncertainties that we are facing and that you've covered in tremendous depth, equities, funds, bonds, government securities, precious metals, property, cash, where would you be putting your money
It's
today?
really, really hard. I mean, you're describing one conclusion that's working for you, which is you're saying, look, you believe in the idea of having a balanced long-term investment portfolio that incorporates your overall view of the world. Unfortunately, while I believe in the wisdom of that, I think my overall view of the world is that so many things are so overpriced here. Now, precious metals are definitely something that's underpriced, whereas I think stocks and bonds are both very overpriced. High yield bonds are particularly overpriced. The overpriced stuff is getting more overpriced. I certainly don't think you want to be shorting the stock market here, expecting it to crash tomorrow, because we've seen so many times that central bank largesse will just inflate it further. But I don't really know how to construct a balanced, diversified portfolio full of assets that I believe in. What that forces me to, this is just my own personal choice, is I'm a full-time trader, and I say trader, not investor, but trader. I look for where I see opportunities for shorter-term trades, the thing that's going to move, I think, for whatever reason, in the next 6 months, not in the next 6 years. It's a better place to be invested in a long-term strategy that you really believe in. I don't have one that I believe in. I don't think it makes sense to go 100% into gold because, as I say, I think there's plenty of room for gold to go down dramatically relative to fiat currency as the dollar strengthens against other currencies. On the other hand, I don't want to be in a balanced portfolio of stocks buying in here at new all-time highs, which is about where we are on the stock market, and bonds that, particularly where you are on the other side of the pond from me, you're looking at negative yielding sovereign debt in Europe. I mean, that's crazy. So to be buying government bonds for the sake of their safety, if you're at the short end of the maturity curve where the safety really is safety, then you're not only not making anything, but you're paying for the privilege of holding those government bonds. As soon as you try to go out the curve to where there's any meaningful return, you end up with so much duration risk that, and I think probably for the foreseeable future, you're going to benefit from that duration risk. I think that you're going to see appreciation in long-dated paper as we head into a recession. I think that long-term bond rates will probably continue to move lower, lower yields, higher prices. But that's a speculation. That's not some truth that I can assure you of. It's a speculation I could be dead wrong about. And if I got that wrong and you go out on the curve trying to get decent prices or decent returns, you could be stuck in an investment that you have to hold for 30 years just to break even because you're losing so much principal value if interest rates end up going up instead of down from here. So you're taking a great amount of risk. Where it puts me is being a trader, not an investor. That's not, I am not invested at all in gold. I think for most people, you probably want to have 10% of your portfolio at least in precious metals as a hedge. Why am I at zero? Well, because I'm sitting looking at the screen for 8 hours a day. And if it moves above 1350, I've got several automated mechanisms to tell me I will not miss it. Believe me, I'm wired into this market. If you can't do that, I think it's a really difficult time. I don't know how to design a balanced portfolio that's diversified. I certainly don't think it's the usual answer of 60% stocks and 40% government bonds. I don't think that's a good place to be.
Spoken like a true trader. Erik, thank you so very much. Before we finish, are there any additional points you wish to make or any further gems of wisdom you can impart to our to our
Well, I
membership?
think we've covered it. Just realize that the bullish gold and silver narrative is incredibly strong. It's incredibly well conceived. It's a good bullish message, but don't ever forget that inevitable does not equal imminent. And there's so many people that are pumping precious metals, are people that have ulterior motives. And, you know, it's one of the difficult problems you get to. There is bona fide good reason to look to physical precious metals over paper products that have risk inherent to, you know, various things that could go wrong in the financial system. But I can tell you right now, the people that are pushing and pumping physical metal are mostly doing so because they can make a profit, you know, a commission on selling you physical metal. Many of them are people that are banned from the securities industry for life because they did some other sleazy thing. So you're dealing with some really difficult characters in the physical precious metals world. That doesn't mean that there isn't a real argument for physical precious metals. So you've got to sort these things out. It's not easy.
Erik, true pearls of wisdom. Thank you so very much once again. Please do come back
It's
in the
been my
future.
pleasure, Richard, and I encourage your listeners to come check us out at Macro Voices. We do more sophisticated content on markets, not just gold and silver, but all markets with a macro focus every Thursday night. And we've just expanded with Macro Voices Premium. So now we're doing an energy podcast, and we've got some other plans for video and other things. So come check us out at macrovoices.com.
We shall do that, and we shall also send an email, a separate email to each of our members as a thank you to you, highlighting the various links as well. So if you provide me with those, we shall ensure that all of our members are fully equipped with your armory. Thank you
Been
so
my
very
pleasure.
much.
So that concludes our 3-part interview series with Erik Townsend. A fascinating insight into an alternative view to a precious metal pumper, while still believing, as we do, that gold and silver has a long-term sustainable future and may prove to be the last bastion of our wealth preservation. It is our intention each month to interview someone of equal caliber so that we can all gain a balanced perspective on this area that we are all involved in and also enjoy. Thank you for listening. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.